Selling your gold could cost you up to 28% in federal taxes, plus another 3.8% if your income is high enough. That's nearly a third of your gains gone, vanished, handed straight to the IRS because you made the mistake of actually selling. But borrowing against that same gold? Zero tax event, not a penny to Uncle Sam. The ultra-wealthy have been exploiting the gap between these two realities for decades, using a strategy called buy, borrow, and pass it on. They buy appreciating assets, borrow against them instead of selling, and when they pass those assets to their heirs, every dollar of accumulated gains gets erased forever through a legal mechanism in the tax code. Wall Street banks and bullion lenders will hand you 50 to 75 cents on every dollar of gold you own, at interest rates far below what the IRS would take. But here's the thing most people don't realize. Congress is now circling this strategy. The Bipartisan Policy Center published a detailed reform proposal in December 2025. And when you see what they're proposing, you'll understand why the window on this strategy may be closing faster than anyone expected. My name is Alex, and I've spent years digging through tax code provisions, wealth management strategies, and Federal Reserve reports so you don't have to. If you want to protect and grow your wealth using the same strategies the ultra-rich use every single day, make sure to hit that subscribe button and give this video a thumbs up if it helps you see the tax game more clearly. Before we dive in, I want to know, do you own physical gold ETFs, or are you still thinking about getting in? Drop it in the comments below, because your answer tells me exactly what kind of content to make next. Today I'm going to walk you through the exact mechanics of how the wealthiest people in this country turn gold into tax-free liquidity, why the math almost always beats selling, the specific risks that could blow this strategy apart, and why there's a legislative clock ticking that nobody in the gold community is talking about. But first, you need to understand the trap that most gold investors walk straight into without even realizing it. Here's what most people get told about gold and taxes. You buy gold, it goes up, you sell it, you pay capital gains. Simple, right? Except that's not how it actually works for gold. The IRS doesn't treat your gold bars and coins like stocks. They classify physical gold, bars, coins, bullion, all of it, as a collectible under Internal Revenue Code rules. And collectibles get punished. While long-term capital gains on stocks and most securities are taxed at 0, 15, or 20% depending on your bracket, collectibles face a maximum federal rate of 28%. That's the cap. If you're in a lower bracket, you pay your marginal rate. But if you're in the 28% bracket or above, you're hitting that ceiling, and it gets worse. According to Kiplinger's analysis from February 2026, high-income taxpayers with modified adjusted gross income above $200,000 for single filers or $250,000 for married couples filing jointly also get hit with the 3.8% net investment income tax. That's the Medicare surtax. So now you're at 31.8% federal before your state even takes its cut. In California, your total effective rate on gold gains can blow past 40%. 40 cents of every dollar you gained, just gone. And here's the part that trips up even sophisticated investors. If you hold gold through a physically backed ETF like GLD or IAU, you're not escaping this. Those funds are treated as collectibles for tax purposes. Same 28% maximum rate. Same 3.8% surtax exposure. The only gold investments that get standard capital gains treatment are mining stocks and mining-focused ETFs, because those are equities, not collectibles. Most people don't know that distinction exists, and the confusion costs them thousands. Now imagine you're sitting on $100,000 worth of gold that you bought for $50,000. You've doubled your money, congratulations. But the moment you sell, you're looking at a potential $14,000 federal tax hit at the 28% rate. And that's before the surtax, before state taxes. In a high-tax state, you could lose over $20,000 of that $50,000 gain. That's not a tax. That's a toll booth on the highway to your own wealth. So what do the ultra-wealthy do instead? They don't sell, they borrow. And what I'm about to show you next is the mechanism that separates people who pay taxes on their wealth from people who almost never do. Pay close attention because this is where the real money strategy lives. Loan proceeds are not taxable income. Let that settle in your mind for a moment. Under current tax law, when you borrow money, regardless of what you use as collateral, it is not a realization event. No capital gains trigger, no tax bill, nothing. This isn't some obscure hack. It's a foundational principle of the tax code. Yale Budget Lab and the Bipartisan Policy Center have both published extensive analyses confirming this. and it applies whether your collateral is stocks, real estate, or gold. So here's how it works in practice. Step 1. You accumulate gold. Physical bullion, coins, or gold ETFs in a taxable account. You hold it, you let it appreciate, you don't sell. Step 2. You take out a loan against that gold. For physical bullion, specialized lenders like Money Metals, JM Bullion, or high-end firms like J. Ropart & Company will give you a loan secured by your metal. Typical loan-to-value ratios run 50 to 70%, so for $100,000 in gold, you could borrow $50,000 to $70,000. Interest rates on physical gold loans generally run 6 to 12%, depending on the size of the loan and the lender. Now, if your gold is held through ETFs in a brokerage account, you have another option. Securities-backed lines of credit, often called SB-locks. Schwab, Morgan Stanley, Goldman Sachs, Interactive Brokers, they all offer these. For gold ETF collateral specifically, you're typically looking at 50 to 70% loan-to-value, with interest rates based on SOFR plus 1 to 4%. That translates to roughly 5 to 8% in the current environment. Schwab's pledged asset line charges approximately 6 to 9% right now, with minimums typically around $100,000 in portfolio value. I can already hear the objection forming in your head. But Alex, you still have to pay interest on the loan. How is that better than paying the tax? And that's the right question. So let's run the math, because the math is where this strategy either falls apart or changes everything. Take that same $100,000 in gold with $50,000 in unrealized gains. If you sell, you pay up to $14,000 in federal capital gains tax at 28%. Add the 3.8% surtax for high earners and you're at $15,900. Add state taxes and you could be well over $20,000. That money is gone, forever. You never get it back. Now instead, you borrow $60,000 against that gold at 8% interest. Your first year cost is $4,800. That's roughly a third of the federal tax hit alone. And here's the critical difference. The gold is still yours. It's still appreciating. If gold continues its historical trajectory, and according to Visual Capitalist data, gold has averaged roughly 10 to 11% annual returns over the 20-year period from 2000 to 2025, your collateral is growing faster than your interest is accruing. But here's where this gets really interesting, and this is the part most people have never heard of. There's a third step to this strategy, and it's the step that makes the whole thing go from smart to generational. If you've made it this far, you're already ahead of 90% of investors. But don't stop now, because what comes next is the piece that ties it all together. Step 3 is the stepped-up basis at inheritance. Under Internal Revenue Code Section 1014, when you pass assets to your heirs, the cost basis resets to the fair market value at the time of your passing. Every single dollar of unrealized gain accumulated during your lifetime gets erased permanently. So if you bought gold at $1,000 an ounce and it's at $5,000 when your heirs receive it, their new cost basis is $5,000. That $4,000 per ounce in gains, never taxed. Not by you, not by them, not by anyone. The estate repays any outstanding loans from estate assets, and the remaining wealth passes forward with a clean slate. Yale Budget Lab describes this as the interaction of three perfectly legal tax provisions: non-taxable loan proceeds, capital gains deferral, and stepped-up basis. Each one is legitimate on its own. Together, they create what is arguably the most powerful wealth preservation strategy in the American tax code. The Bipartisan Policy Center estimates this strategy is primarily utilized by ultra-high net worth individuals, those with more than $30 million in investable assets, representing fewer than 450,000 people worldwide. Now I need to pump the brakes here because I'd be doing you a disservice if I painted this as risk-free. It's not. And the risks aren't theoretical. They're real, and they can be devastating if you're not prepared. Risk number 1 is margin calls. If gold's value drops below your lender's maintenance threshold, you'll be required to post additional collateral or repay part of the loan immediately. At 50 to 70% loan to value, a 30 to 40% decline in gold prices could trigger a call. And before you say gold doesn't drop that fast, gold fell 28% in a single day in January 2026. That is not ancient history. That is recent memory. If you were leveraged at 70% LTV when that happened, your lender was on the phone before your morning coffee. Risk number 2 is variable interest rates. Most SB locks and bullion loans carry variable rates. If rates spike significantly, your carrying costs climb and the math starts to look very different. In a sustained high-rate environment, the cumulative interest cost over 5 to 10 years can approach or even exceed the one-time tax hit you were trying to avoid. Risk number 3, and this one is psychological: opportunity cost. Your pledged gold cannot be sold, even if the price spikes to a level where selling would be optimal. You're locked in for the duration of the loan. And risk number 4 is the one that keeps wealth advisors up at night. The loan is a real liability. It must eventually be repaid. If gold drops and you can't post additional collateral, lenders can seize and liquidate your gold, potentially at the worst possible time, at the bottom of a decline, crystallizing losses you never intended to take. Now there's a psychological dimension here that I think is worth exploring, because understanding the mechanics of this strategy isn't enough. You need to understand why it works on your brain, and why most people will never use it even after they learn about it. The reason most investors sell their gold and pay the tax is because of how we're wired. We crave certainty. Selling gives you cash in hand. It feels clean. It feels finished. Borrowing against an asset feels like you're adding risk, taking on debt, creating complexity. And your brain interprets complexity as danger. But here's the hard truth. The people who build multi-generational wealth don't optimize for comfort. They optimize for tax efficiency. They're willing to carry the psychological weight of an open loan because they've done the math and they know the math doesn't lie. The ultra-wealthy aren't smarter than you. They have access to strategies and advisors that reframe how they think about assets, income, and taxation. They don't think of gold as something to sell when they need money. They think of it as collateral, an engine for liquidity that never triggers a taxable event. This is the part where most people check out. Don't be most people. Because the final piece of this puzzle is the one with a ticking clock. The Bipartisan Policy Center published a detailed analysis in December 2025 outlining multiple reform proposals targeting exactly this strategy. Option 1 is an excise tax on securities-backed borrowing above certain thresholds. We're talking 1% on amounts above $1 million, 2% above $2.5 million, with a $500,000 annual exemption. Option 2 is even more aggressive, treating borrowing against appreciated assets as a deemed realization event, which would trigger capital gains tax at the time of borrowing. That would effectively eliminate the strategy entirely. Option 3 is a 10% flat withholding tax on all loan proceeds, creditable against future capital gains liability. Yale Budget Lab modeled these proposals and estimated they would affect approximately 295,000 to 375,000 taxpayers in 2026 and raise meaningful revenue. Senator Ron Wyden and 15 other Democratic and independent senators have introduced versions of a billionaire's income tax that would target unrealized gains even more broadly. Now here's the important nuance. Under the current Republican-controlled Congress, none of these proposals appear likely to advance in the near term, but political landscapes shift. What's unlikely today can become inevitable tomorrow, and if you're building a multi-decade wealth strategy around the interaction of loan proceeds, capital gains deferral, and stepped-up basis, you need to understand that any one of those three pillars could be modified or eliminated by future legislation. Almost there. But before I wrap up, let me tie all of this together, because when you see how these pieces connect, the whole picture changes. The tax code creates a trap for gold investors who sell. Up to 28% federal, plus 3.8% surtax, plus state taxes. That trap is avoidable, legally, through borrowing against your gold instead of liquidating it. The loan gives you liquidity without a tax event. The gold continues to appreciate. And if you hold until your assets pass to heirs, the stepped-up basis under Section 1014 erases every dollar of accumulated gains. The risks are real: margin calls, variable rates, opportunity cost, and the loan itself is a genuine liability. But for investors with sufficient wealth and proper risk management, the math overwhelmingly favors borrowing over selling. And the legislative proposals circling this strategy mean the calculus could change. Not tomorrow, probably not this year. But the window is not guaranteed to stay open forever. Remember that 31.8% effective tax rate I mentioned at the beginning? The one that can climb past 40% in high tax states? That's the cost of not knowing this strategy exists. That's nearly a third of your gains, evaporating because you did what most people do: you sold. The ultra-wealthy don't sell. They borrow, they hold, they pass it forward. And every dollar of gain that would have gone to the IRS stays in the family instead. You're not pushing that boulder uphill anymore. You're building a system where the boulder rolls on its own. Your future self, the one who's built real, lasting, generational wealth, is counting on you to stop thinking like a taxpayer and start thinking like an owner of capital. The information is in front of you. The strategy is legal. The math works. What you do with it is up to you. Gold, taxes, wealth strategy, estate planning. What do you want me to break down next? Drop it in the comments because that's exactly what this channel is for.